there a little thing that comes up? Oh, there we go.
Yeah, there is. Hello, good afternoon. I'm Elise Hatton from Rockhampton Regional Council Smart Hub. Welcome to today's Hub Live. I'm here with the incredible Michael Beck from Central Queensland, partner for Worrells. Hello, Mr. Michael Beck. How are you?
Good. Thanks for having me along, Elise.
Oh, thank you so much for coming along to share your insight and your wisdom. Now, as the marketing said, 2020 has been a pretty rough year. Has it been rough for you guys?
Exceptionally rough. You know, the world's been in absolute turmoil.
It has, hasn't it? And I think a lot of things have shifted and changed. And again, as the marketing indicated, the government's been really good at helping small businesses and businesses, people in business in general, kind of keep things afloat. But that cannot go on forever. And so Worrells let me not preempt it. Let me not introduce you. Tell us more about Worrells.
Okay, so obviously, as Lee said, my name's Michael Beck. I'm the Central Queensland partner for Worrells. Now, our firm primarily specialises in debt advisory and solutions, along with dispute matters. We've got, I think the firm's been around for something like 48 years. We've got 38 partners Australia-wide, and in Queensland there's about 12.
We have to tell a really funny story. When we first reached out to Worrells, we actually spoke to one of your partners in WA, I think it was, or maybe Victoria. It was a Victoria.
No, WA.
That was a WA, and yeah. He thought that we were from Rockingham and not Rockhampton, and so that was in his patch. But now you're with us, which is awesome.
Yeah.
He referred us to you.
Yeah.
Okay, so tell us a little bit more about what we can do when these government incentives end and how we can prepare for that. I have to say that many of our HubLive topics are suggested by some of our members. So the fact that we have you here is because of people have come up and asked whether there is something that we can talk about around this issue. So I'm really grateful that you're here to share. So maybe you'd like to share your screen and give us a bit of a of a rundown.
I can do that. So. Okay, can you all see that?
Yes, we can, perfectly.
Okay, so as Elise raised, 2020's been a absolutely tumultuous year. The COVID pandemic has sent the world into a horrible lockdown, causing massive disruptions across all industries. And I guess that's where we find ourselves today. The government, federal and state governments have been ploughing stimulus, relief and incentives into the economy to support businesses that, some businesses that would otherwise have simply failed. So I guess the question is, what's going to happen when the funding and or the incentives stop, and what options are available? Okay, before we go any further, I'll just put up this disclaimer. Any information during this presentation is general in nature. I really want to emphasise that every single matter that we deal with is different, and the advice we give is based on each set of circumstances at the time, whether it be an individual that's racked up some credit card debt, companies with secured bank debts guaranteed by directors, building companies owing money to subcontractors, trusts that have racked up some tax debt, disputes between family members, the list goes on. So, look, as I said, I really want to emphasise every single matter is different. And despite what some people think, my advice isn't always just to go bankrupt or to place a company into liquidation. Okay, so we mentioned COVID, and I just thought I'd run through a couple of points that I think people should keep in mind. Now, whilst COVID has had a significant impact on the economy and on businesses, there's obviously been a lot of government assistance and relief that's been provided. And I guess some of this relief will provide an opportunity for you or your clients to actually get ahead, whether the assistant clears up old tax debt or provides additional funds to look at opportunities to expand. Next one is moratoriums. Please remember they're only temporary, and sooner or later things will go back to normal and debts or bills will need to be paid. Insolvencies. Okay, there's been plenty of commentary about a tsunami of insolvencies that's going to happen in the future. And to be honest, that's music to my ears. However, nonetheless, I don't like to see any business fail. But nonetheless, such failures do provide opportunities for other businesses to expand or to acquire other businesses. Now, next, when things go back to normal, there's likely going to be a significant number of creditor payment defaults. Now, I think that's important for you and your clients to consider when you're planning cash flow. The next up, first mover advantage. Anyone owed money will get an advantage if they start recovery actions sooner rather than later. And last, and definitely not least, probably more important, if you're having some issues or COVID's caused or impacted your business significantly, start planning now. You know, you've got to remember, hope's not a strategy. Don't leave anything to chance. And it's a fairly important time for clients to seek the right advice rather than stick their heads in the sand. Okay, so what's going to happen when the funding or incentive stops, and what options are available? Look, the first one and the most obvious is pay your debts, which might include obtaining finance or borrowing funds from family members. Chances are, if you're talking to me, it's probably not an option, and all the funds that can be raised can't pay all the debts. So today we're going to be discussing informal debt negotiation, formal debt proposals by way of a deed of company arrangement or for an individual Part 10 personal insolvency agreement or Part 9 debt agreement. And I'll also go through the government's new proposed legislation, which is meant to come into effect in January 2021. Okay, first up, informal debt negotiation. Now, I'll go through an example on this. It's for an individual, but it can equally apply to a company. Okay, now, an informal debt negotiation is quite simply just putting a proposal to creditors to resolve or settle debts owed to them. Generally speaking, if you or a client want to do an informal debt negotiation, there should be a good reason why. Reasons can include licensing issues, whether it be with QBCC, your real estate licensing, etc. You might have someone that owns a property that has future development potential. You or your client may have concerns about the effect that bankruptcy or a liquidation may have on the ability to obtain credit. There's a whole range of reasons that people wish to do informal debt negotiations, and a lot of the time it can simply be pride that they don't want to go bankrupt, which, to be honest, is just as valid a reason as any. Now, an informal debt proposal can incorporate absolutely anything, as long as it's attractive to creditors. More often than not, they involve providing a new source of funds or a proposal to make payment over time. One of the issues with informal debt negotiations is they generally require all creditors to agree to the proposal, which can be quite difficult when you've got a large body of creditors. As such, they tend to be better suited when there's a smaller number of creditors involved. Okay, quick example of the matter that I handled. So it was a mum and dad that basically bought a franchise business for their daughter. The mum and dad were directors of the company, but weren't really involved in the business. To purchase the business, mum and dad obtained finance from the bank and put their home up as security. They also personally guaranteed the franchise agreement. I guess all things a parent should never do. few years down the track, the daughter decided to leave town and left mum and dad sitting there with a business that they had limited knowledge how to run. And then subsequent conduct by the franchisor significantly impacted on the profitability of the business. Long story short, business shut down. Family home was sold to repay the bank debt, and there's a surplus of about $100,000, which they bought to buy a rundown house with the hopes of renovating it. 2 years on, the franchisor came chasing a debt of $386,000 for outstanding royalties, advertising fees, and also seeking damages for the early termination of the franchise agreement. Now, both mum and dad were at retirement age, had drawn almost all of their super to keep the business afloat, and were now faced with the prospect of absolutely losing everything. So I guess the approach I took in that matter was, in the first instance, the franchisor was using a debt collection agency. And the fact that mum and dad had approached our firm and we were speaking to them basically told that debt collection agency that there was a real threat of bankruptcy. Now, when you put that in a creditor's mind, creditor's mind, and if bankruptcy occurs, there's a chance that the franchisor would have had to wait a couple of years to recover anything. And there's also the risk that they may not get anything. The second thing I did was to set out their financial position and the potential outcomes in bankruptcy. The third, the threat of negative publicity to the franchisor. It was a national franchise that really didn't want to get dragged into a story on a current affairs about how they ruined some retirees. Fourth thing I did was I played on the heartstrings. Daughter abandoned them. Mum and dad have limited assets, now have to work well into their retirement age to survive, and will potentially be out on the street if a deal can't be struck. And the last thing I did was to remind them of the cost to actually go bankrupt someone. Okay, it's easy to file for bankruptcy yourself, but if you want to force someone into bankruptcy, it's probably, at the moment, it'd take the best part of 12 months, and it would cost somewhere between $10,000 and $15,000 between court filing fees and legal fees. Okay, so what was the outcome? I originally settled the claim for 20 grand. However, mum and dad had some issues with the house, so I squeezed a further reduction out of them such that it was settled for 15,000 with payment over time. Mum and dad kept the house. They now have somewhere to live when they retire, and they also managed to retain a small amount of funds. Now, if you or your clients are actually doing an informal debt negotiation, it's important to remember that it needs to be in writing, and it needs to state in full and final satisfaction of all claims between the parties. I see it time and time again. People think they've actually settled a debt by way of a phone call. They go and pay a lump sum amount of 10 or 20 grand, and then the debt collection agency continues chasing them for the balance and potentially bankrupts them.
Wow. My goodness, Michael, can I stop you there? That is a scary, scary story. There are so many lessons in that for parents, for children, for going into business, going into franchise agreements, and also for how to negotiate debt. That's a phenomenal story. Hey, Simon, hey, Nanette, thank you so much for joining us today. I'm here with Michael Beck from Worrells, the Central Queensland branch or the Central Queensland partner. If you have any questions for Michael, please feel free to put those in the comments and we'll be sure to answer those for you. So tell us more, Michael.
Okay, so anyway, whilst that example was just for some individuals and only involved one creditor, the same principles apply whether it's an individual or a company. As I mentioned earlier, the issue with informal debt negotiations is you generally need all creditors to agree, but that doesn't mean there can't be negotiation with each creditor individually. Okay, formal debt proposals. Now, the example I'm going to give involves a corporate entity, but please note that formal debt proposals are available for individuals to be put forward under the Bankruptcy Act, whether it be by way of Part 10 personal insolvency agreement or a Part 9 debt agreement. Regardless of whether it's a company or an individual, have basically largely the same concept, which is they've got to provide a better return to creditors than the outcome in either bankruptcy or liquidation. The benefit of a formal debt proposal over an informal debt proposal is they don't require all creditors to agree to the proposal to necessarily bind all creditors. Now, on a corporate entity, for it to put forward a formal proposal, what happens is the company first goes into voluntary administration, and then they put forward the proposal by way of what's called a deed of company arrangement proposal, a DOCA. More often than not, it's put forward by the directors, but they can quite often be put forward by a third party, whether it's a creditor or whether it's a purchaser of a business. Virgin Airlines is one example of that. They acquired the business by way of a deed of company arrangement. Our firm did a similar thing with Napoleon Purtis. That was sold to an Asian, but it wasn't actually a sale. They put forward a proposal to acquire through a deed of company arrangement. And there's various reasons for that, whether they want to retain branding, don't want to lose leases, like property leases, stuff like that. Okay, now up here on this slide, these are basically the stated purposes of voluntary administration, and that's to save the company's business or as much as possible, to get a better outcome than liquidation, to make the process easy, quick, and less expensive. And as I'll discuss later on, that's been open to a lot of criticism. Okay, now when a company goes into voluntary administration, it's actually creditors that decide the future, and the options available to creditors are return the company back to directors. Now, this assumes that a company can pay its debts as and when they fall due, and that the company should never have been in actual voluntary administration. I've never actually seen that occur. The next option is creditors can vote that a company go into liquidation. Now, that'll generally occur if there's no deed of company arrangement proposal put forward or the proposal's not agreed to. And the third option that I canvassed just before, creditors accept the deed of company arrangement proposal put forward. Like an informal debt negotiation, deed of company arrangement can be absolutely anything. It just needs to provide a better outcome than the outcome in liquidation. Okay, I'll move on to a quick example of a matter that our office here handled. It was a manufacturing business, long-standing family business, turnover of approximately 6 to 8 million, using an accounting system almost as old as the business, because it'd been around 30, 40 years. Approximately 40 staff, secured bank debt of 1.5 million. Business suffered significant bad debt, but it still managed to battle on for some time. But over time, the tax debts and supplier debts crept up to around $2 million. They subsequently received a demand from the liquidator of that bad debtor, about $400,000. Then over the Christmas period, some of the jobs they were doing didn't pan out as expected, which impacted their cash flow and the ability to trade on. Now, if the business closed and terminated all staff, then it would have crystallised an employee entitlement bill of approximately 1.25 million. Now, when they're talking to me, they were already struggling with funds to continue to trade, so they had no chance of paying the employee entitlements if they were terminated. Now, the options to them were do nothing. Now, they might have been able to continue on for a short while, but eventually they would have had to close because they didn't have the working capital to continue. And some of the suppliers had already started putting them on stop credit. Next option was cease trading, place the company into liquidation. This would have seen the company's assets auctioned off generally considerably less than the book value. would have crystallised an employee entitlement liability of 1.25 million. There would have been a shortfall on the secured debt to the bank, which would have then caused the bank to enforce its security over personally owned family assets. And there would have been absolutely no return to unsecured creditors because employee entitlements get a priority. Now, the third option was that they place the company into voluntary administration with the prospect of putting forward a deed of company arrangement proposal, so an offer to creditors. Obviously, they made the wise decision. They contacted me and put the company into administration with our firm as the administrator. Now, just to clarify, the role of the administrator is to take control of the company and continue trading the business, assuming there's sufficient funds to continue to trade. Secure and assess the realisable value of the company's assets, conduct investigations into the company's affairs to identify offences under the Corporations Act and make an assessment of any recoveries that may be available to a liquidator. Next is to negotiate and formulate a deed of company arrangement if one's to be proposed. And then basically the final step is to issue a report to creditors and provide a positive recommendation on whether creditors are better off accepting the proposal or whether they're better off having the company go into liquidation. Okay, so what did we do once we were appointed? Here are some of the initial tasks that we attended to in the first couple of days. In addition to these tasks and the tasks ordinarily associated with trading and business, we also conducted investigations, dealt with staff and payroll issues, liaised with the bank over their secured debt, monitored work in progress, debtors and cash flow to ensure that we had sufficient funds to trade the business. And the reason we do that is because if we don't, we're personally on the hook for the debts that we incur. Now, we also identified issues that needed to be addressed for the future viability of the business and liaised with the director accordingly on that. And then we worked closely with the director and the accountant during the administration process to assist directors with putting forward or formulating their deed of company arrangement proposal, so their offer to creditors, and to also assist them dealing with the secured creditor, because at the end of the day, the bank was always going to want some comfort that the debt's going to be repaid. Okay, in the end, the director put forward a DOCA proposal that essentially provided for a payment of $100,000 from a family member, which was going to provide an approximate dividend of 5 cents in the dollar to ordinary unsecured creditors. Control of the company was going to be handed back to the directors, or that was part of the DOCA. One of the other conditions, related parties would not participate in any dividends, but they retain their voting rights. Now, to appease the ATO, there's a condition under the DOCA that the company maintain its future tax lodgements and liabilities. Employee entitlements would continue to be paid in the ordinary course of trade. And the other thing that I assisted the directors putting in the proposal was that any surplus funds that the administrator had be handed back to the company to assist with its working capital requirements. You got to remember, it had 40 staff. So I think the payroll was about 80 grand a fortnight, $90,000 a fortnight. So they're always going to need some cash to continue to be able to trade. Okay, so what was the outcome? Now, whilst only a return of 5 cents in the dollar on what creditors were owed, and when I say creditors, I'm talking about unsecured creditors. Your trade creditors overwhelmingly voted to accept the DOCA, so the proposal, because otherwise they were going to get absolutely nothing. It was overwhelmingly supported by suppliers, which wasn't surprising given the long trading history that the company had with suppliers. Now, upon acceptance of the DOCA, it basically removed $2 million worth of bills that would have had to come out of cash flow at some point in time. Now, the ATO, they were owed about $1 million on the matter. Now, they abstained from voting. They didn't vote against the proposal. Rather, they just allowed your local trade creditors to decide on the future of the company. Now, all staff kept their jobs and the company didn't have to stump up $1.25 million in employee entitlements in one lick. And to date, we've handed back about $250,000 in surplus trading receipts, and I'm expecting we'll probably give them another 30 or 50 yet. Now, it's for the directors' business as per usual, albeit with a very steep learning curve. Now, even though control of the company's been handed back to the directors, I still maintain contact with them to ensure they're addressing the issues we identified. And I do that on all our VA docket proposals.
How long did that take? How long did that example take to get to the end, to where you're just keeping in touch?
So that's about 5 weeks, basically. So
Wow.
your voluntary administration period is, so they call it a convening period. So it's 20 business days. So you've got 4 weeks there. And then we've got to issue a report at the end of that convening period to creditors, giving them a recommendation on how their interests are best served. Okay. And then we hold a meeting within 5 business days at the end of the convening period. So 5 weeks. And there's some messing around straight after that, because you've got to work out what your surplus trading receipts are, but control reverted back to them 5 weeks after our appointment.
Awesome.
Okay. So they're informal debt negotiations and the current legislative framework to do a formal debt proposal. I'll touch on the legislation update, and I suspect this is what a lot of people are interested in. Now, as we've canvassed, COVID-19's caused a lot of turmoil around the world, and governments have scrambled to implement or provide relief and implement legislation to help deal with that fallout. Now, from an insolvency perspective, the year has ended with the government announcing new corporate insolvency regimes specifically designed for small businesses. However, for our industry, the turmoil was actually further exacerbated by the fact that the proposed legislation hasn't actually started, and it's not due to start until the 1st of January. We don't have all the laws. We have sections of the Act, but we don't have the regulations and the rules. And a lot of what's actually said in the explanatory memorandum and the fact sheet is said to be in the rules and regulations, which we obviously don't have. So as I go through this section, I really want you to bear in mind that it's very much a broad brush approach to how the new regimes are supposed to work. To be honest, the government providing us with only half of what is ultimately going to be the law really raises more questions than it does provide answers. Okay. Now, these new reforms have seemingly come out of the blue, not only for the insolvency profession, but based upon a meeting with ASIC that we participated in a few weeks ago, for the regulators as well. And we're not talking about minor changes. These new proposed administrations, will be the first new corporate insolvency regimes since the introduction of the voluntary administration process was introduced back in 1993. So what's the new regimes all about? Well, basically, the government said that the current insolvency system is a one-size-fits-all process with barriers of high costs and lengthy processes. The government feels that we need an insolvency process to better serve small businesses, their creditors and the employees, with the aim of the new insolvency regimes to enable small businesses to quickly restructure, and where a restructure isn't possible, to be wound up faster, enabling a greater return to creditors. And I guess the government thinks we need it now, because otherwise the fallout from COVID-19 is going to cause that so-called tsunami of insolvencies that will have an even greater impact on an already fragile economy. Okay, now the new regime or proposed regimes are made up of 3 elements. The first is temporary relief for companies seeking a restructuring practitioner. Basically, this is an opportunity for companies to have creditors' debts put on hold while it explores the options available to get out of its dire financial position. The next element is the restructuring of a company. This is basically a simplified system to make an arrangement with creditors to avoid liquidation, similar to the VA, voluntary administration / deed of company arrangement process that I mentioned before. Excuse me. And the third element of the new regimes is a simplified liquidation process. As the name suggests, this is still the end of the life of the company, but with reduced red tape. Okay, quickly touch on the first element or first proposed regime, which is temporary relief for those seeking a restructuring practitioner. Now, the fact sheet on this has suggested it's something similar to temporary debt protection that's actually currently available under the Bankruptcy Act for an individual who's wanting to consider their personal insolvency options, but feel they can't do so because they're receiving too much pressure from their creditors. For an individual, you can lodge this temporary debt protection form that gives creditors a moratorium on their creditors' debts. And from memory, it's about 21 or 28 days. Now, in the case of the new temporary relief that's being proposed for anyone seeking a restructuring practitioner, there'll be a hold on creditors' ability to pursue debts against the company for 3 months. Now, what does the new proposed law actually say on this? Absolutely nothing. Okay, it's just in one of the government fact sheets. So I'm not entirely sure how we can elaborate any further on the matter other than what's been stated in the fact sheet.
I suppose it's more of a watch this space kind of
Pretty much. It's all very much up in the air. The consultation period on this new proposed legislation was 7 days.
Okay.
7 days. That's it.
Yeah, it's crazy short. Yeah, for government. Yeah.
Okay. Now, the next element or new proposed regime is basically the debtor in possession restructuring model. The restructuring of company is this proposed new restructuring regime is probably at the heart of the government's proposals, because the government really wants to save as many small businesses as they possibly can. The logic, of course, is that the economy is never going to be able to recover if most of the businesses in the country fail. So let's remove some red tape and get out of the way of debtors doing deals with their creditors. Now, Australia has traditionally had what is called a creditor in possession style model of insolvency. That's basically because all of our current insolvency regimes take control of the company away from the owners and give that control to an insolvency practitioner whose interest is basically instructed by creditors through us. So, and I guess the reason for the creditor in possession style model that currently stands is that we shouldn't leave control of the company in the hands of the very parties who got the company into its financial problems. Now, the new proposed restructuring system moves away from that to a debtor in possession style arrangement. So under this new regime, whilst a restructuring practitioner is appointed, they're really there to assist the directors because control of the company and the continued trade of the company remains with the directors. The aim of this part of the legislation is like the aim of the voluntary administration scheme, and that is to have a plan in place for the company to repair its existing debt problems, thereby staying in business and avoiding liquidation. I guess the government's hopeful of seeing greater returns to creditors and a greater number of companies remaining in business. Okay, fortunately for us, the government has provided a fact sheet which quite conveniently gives us a diagram of the steps that the new structuring process will occur during this new restructuring process. Okay, the first step is basically the process starts like any other insolvency process with the appointment of a relevant insolvency practitioner. Now, it's important to note that only directors can initiate the appointment of a restructuring practitioner. Not even the court can initiate that process. And like all other current insolvency administrations, once the process has been initiated, the director can't just change their mind and revoke the appointment. Once the process is started, they've got to complete the process. Now, the proposed small business restructuring practitioner is our understanding, is to be a registered liquidator. However, in an effort to broaden the expertise that's available to companies to restructure, the idea is actually to create a new class of registered liquidator who is only approved to do these new restructuring processes. At this stage, we're not sure of the qualifications required to be approved as a small business restructuring practitioner. And to be honest, neither is the regulator, so ASIC, because the government hasn't told them. But based on our discussions with ASIC, they've got to be a registered liquidator. Now, strangely, the diagram suggests that the practitioner confirms the eligibility of the company to actually access the restructuring process, which seems to imply that it's done after the restructuring practitioner is appointed, which we find slightly odd in that one would have thought the actual practitioner could do that before they're appointed to avoid any complications. I guess from our perspective, we don't want to be appointed for half a day or a day to find that the company should never have even been in the process. Nonetheless, companies basically, based on the information available, companies excluded from actually entering this new simplified restructuring process if the company has previously been through a restructuring or a simplified liquidation. Now, this isn't actually in the draft law. The legislation doesn't currently provide for any restrictions on the company entering the restructuring regime multiple times. The government marketing material mentions a restriction if the company has been through a previous restructuring or simplified liquidation inside of the last 7 years. However, as the law currently reads, you could do a restructure, then 6 months later do another one, and so on and so on. The only restriction is that you can't do a restructuring when you're currently in external administration. Interestingly, the explanatory memorandum indicates that they want restrictions if the company has been in a previous restructuring or simplified liquidation, but not any other form of insolvency administration. So as it stands, you could have a company that completes a deed of company arrangement and then later within the 7 years do one of these simplified restructuring processes. Now, the next restriction is if the current director or a director of the company within the last 12 months has been a director of another company under restructuring or simplified liquidation. Again, the time frame is not set in the law, although the fact sheet suggests 7 years, nor is there an exclusion if you've been a director of a company that's been through another type of insolvency administration, like a regular liquidation. Now, the third restriction is if the company owes more than $1 million. Again, we have a situation where the fact sheet sets out $1 million, and that's what everyone's expecting, but it's not actually written in the law. We're not even sure whether the debt level is inclusive or exclusive of secured creditors. It's basically left to be provided in the regulations, which we don't have yet. Now, the fourth restriction is there's been a suggestion in the releases from the government that the company will also need to have its tax lodgements up to date and its employee entitlements paid in full. But again, neither of these provisions actually appear in the law. And in fact, there's not even a suggestion that they might appear in the regulations. So we're basically going to have to wait and see what the government comes out with. Okay. Uh, Now, putting all that to the side, let's assume that you or your client pay their outstanding superannuation and other employee entitlements if that's what's required, and they therefore qualify to do this simplified restructuring process. So where do we go from here? Okay, well, like the voluntary administration process, the law is currently set up that there'll be two notices creditors. The first is on the appointment of one of these small business restructuring practitioners, and the second includes a proposed restructuring plan that creditors actually vote on. Almost identical to the voluntary administration process. Now, we sometimes wonder whether the people who write the law have all done English majors and are remunerated based on word count, because the legislation is very big on this term technology neutral, which basically means in this circumstance via email. Now, the government's fairly anxious to ensure that the process is as speedy and as cost-effective or efficient as possible. So in respect of these two notices, the restructuring practitioner will be able to send them by email to creditors if they have email addresses for those creditors. And it'll be up to creditors to advise if they don't want to receive correspondence via email, which is in contrast to the current system where insolvency practitioners have to get permission to email correspondence.
Can I just ask a quick question, right?
Yep.
Technology neutral means email. I would never have made that link. How do you know that technology neutral means email?
Good question. So we're not even sure where that term came from, but I think the intention of that term is to use any technology that's available to achieve the outcome.
Okay, to communicate quickly.
Yeah.
Okay.
Okay. Now, third step. Now that the practitioner is appointed, what happens? Well, the director is actually required to prepare a restructuring plan. Now, it's important to remember it's only the director that can propose a plan, no other party. So unlike Virgin or Napoleon Purtis, where you've got a third party putting forward a proposal, it's only the director that can. Now, the restructuring practitioner is to provide advice to the director, and assist the director in preparing the restructuring plan. As part of that, the director is required to give information about the company to the practitioner and allow the restructuring practitioner to inspect the books and records so that the practitioner can ultimately make a declaration to creditors leading up to the vote on whether they should accept the proposal or not. Again, very similar to a voluntary administration process where we issue a report and we give a recommendation to creditors. Now, at any point in the restructuring process, the practitioner does have the power to terminate the proposal or the restructuring plan. Now, they can terminate it on two grounds. If the company fails on its eligibility or it becomes apparent during the process that the creditors exceed the limit, or at the moment it's expected to be $1 million, or if the practitioner believes it's in creditors' best interest to terminate the proposal. For example, that if we discover that directors have participated in misconduct, Phoenix activity, hoovered cash, that sort of thing. Okay, now what about the power of other parties who are affected by the restructuring? Well, in respect of the company, it basically continues to control its own assets. The director of the company continues to control the company's assets and trading. So you've got to remember, this is a debtor in possession model. So control of the company remains with the directors, whereas the opposite currently, the current regimes, the opposite applies. Control's removed from the directors. Okay, now there's some limitations in respect of that control, in that the company can only enter into transactions in the ordinary course of business unless, of course, they obtain the permission of the small business restructuring practitioner or the court. The company is to have, one of the other complications is the company is required to have restructuring practitioner appointed, appear on all of its public documents whilst it's in that restructuring phase. Now, similar thing happens under the voluntary administration process. You've got to have voluntary administrator appointed or administrator appointed in brackets after the company's name. Now, doing the same thing during this restructuring process may cause some issues in the continued trading of the business. It happens in voluntary administrations. Once someone sees that again behind the name, they'll stop supply. So it could cause some issues. Now, one of the other things which I think is important to note is that once a company enters into this restructuring process, the company is deemed to be insolvent, which will, of course, assist any creditor applying to court to wind up the company. Okay, they don't have to go and issue a statutory demand. And by doing this, it's an automatic event of insolvency, which is grounds to apply to court. Now, through the process, secured creditors will maintain much of their rights, similar to the voluntary administration process. They'll be limited on their ability to appoint a receiver within a certain time frame. As expected, the rights of unsecured creditors are going to be affected. Basically, they're going to be prevented from taking any further steps to recover their debts. If a sheriff's been appointed by the court to sell companies of the assets and the company goes into this restructuring process, that will cease, or the proceeds that the sheriff holds will go back to the restructuring practitioner. During this process, personal guarantees against the director and their relatives can't be enforced. Interestingly, we couldn't find there any restrictions on the tax officer's ability to enforce a direct penalty regime. Likewise, landlords, they can still take possession, can't take possession of a company's property without the consent of the restructuring process. Next step. Now, the proposed restructuring plan, of course, will be designed to deal with the company's debt and allow the company to continue on into the future. However, the government has flagged that what can be in the plan won't be open-ended, because the draft legislation sets out that the regulations may provide for numerous restrictions on the plan. As I've previously said multiple times, we don't have the regulations. We don't know what the restrictions will be. Okay. Next, back to this fantastic term, technology neutral. In respect of the circumstances around giving notices to creditors and allowing creditors to vote on the proposal, it basically means that there's not going to be any physical meetings, and the system of voting could actually be done by some polling software. Now, the government has suggested that related parties won't be able to vote on the restructuring plan, so as to avoid plans being voted through that are not in the interests of unrelated creditors. However, this isn't currently in the draft legislation, but the explanatory memorandum indicates that the regulations may provide for it, regulations which we don't have. Now, it's also been suggested that a resolution may pass if a majority in creditors by value vote in favour of the restructuring plan. But again, this isn't currently in the draft. Okay. Now, once a restructuring plan is commenced, we're not entirely sure whether the rights and obligation of all the other parties are to be contained within the restructuring plan, or whether the regulations are going to set out the requirements. Once the regulations are out and we know, we'll obviously be in a better position to give some guidance on the matter. Okay, if creditors vote, so let's hypothetically say it's gone to the vote. If creditors vote against a restructuring plan, or if no restructuring plan is put forward, then unlike the current voluntary administration regime, there's actually no ability for creditors to vote to put the company into liquidation. The government material indicates that at that point, it's up to the directors and shareholders to decide what to do with the company, or for creditors to actually apply to court to have the company wound up. Now, and in keeping with the government's protections for directors from insolvent trading, the safe harbour rules, current safe harbour rules, apply for debts incurred during the restructuring process, which just means if the directors incur debt during the restructuring process, they can't be pursued for insolvent trading on those debts. Okay, that's basically the proposed restructuring process and the steps required. As I've said, it's all up in the air at the moment. We don't have all the rules and regulations. We've just got the government's idea of what they want to do.
Wow. Okay, we have an idea. We have a bit of an overview at least. When do you think the legislation will be finalised?
It's meant to come into effect on the 1st of January.
Right.
So
soon.
They're running out of time very quickly. If you take into account Christmas, we've basically got a month left in the year.
Yeah.
Okay. So we're not sure. They've raced it through, and it's no doubt it's going to cause more issues than assistance it's meant to provide.
Yeah, I see what you mean.
Look, I'll quickly touch on the final proposed new insolvency regime, which is a simplified liquidation process. Now, it can be used for any liquidation after 1 January 2021, so it's not retrospective. And the company does not need to have gone through the restructuring process to avail itself of the simplified liquidation. However, the simplified liquidation only applies to creditors' voluntary liquidations. Now, they're initiated by the directors and shareholders where there are outstanding creditors, or they come about via the failure of voluntary administration or deed of company arrangement. So whatever the trigger is, as long as you've got a CVL, the simplified liquidation process is available. Now, the draft legislation is written such that once a company is in liquidation and the director has completed the relevant forms, the liquidator can give notice to creditors that they're going to adopt the simplified liquidation process. Now, a company isn't eligible for the simplified liquidation process if the current director or any director inside of the last 12 months has been a director of another company that has gone through either the restructuring process or simplified liquidation. If the director has been involved in another type of external administration, for example, receivership, voluntary administration, or normal liquidation, then there appears to be no exclusion on using the simplified liquidation. Okay, again, there's been suggestions to actually access that simplified liquidation process. Employee entitlements need to be up to date, debts need to be less than $1 million, and tax lodgements have to be up to date. However, again, the draft legislation doesn't actually set these criteria out. It merely says that the regulations may provide for these things. Okay. Simplified liquidations. Now, the whole purpose of the proposed simplified liquidation is to make it quicker and cheaper. Unfortunately, we're not sure whether directors or creditors are going to see a huge difference between the simplified liquidation process and an ordinary creditor's voluntary liquidation. And that's because, look, the simplified liquidation process basically provides that liquidator is not going to be required to file any reports with ASIC unless they identify breaches. There will be no meetings of creditors as currently required under Insolvency Practice Schedule 7510 and 7520. I'll be honest, I probably, other than on voluntary administrations, I haven't had a liquidation on had a meeting of creditors on a liquidation in the last 2 years. So there's not really going to be much of a saving there. There'll be no requirement for a committee of inspection. Again, so a committee of inspection is probably 5 or 7 creditors that are appointed to represent a large body of creditors. Again, in my entire career, I've probably seen 4 or 5 committees of inspections. Now, there's no ability to appoint a reviewing liquidator by ASIC or creditors, which very rarely occurs. The regulations may provide for a variance in the liquidator's ability to pursue unfair preferential payments. Now, we would suggest that the ATO might have had a hand in this legislation because more often than not, our preference claims are against the tax office. I would hazard a guess I have anywhere between 2 to 5 preference claims against the ATO on at any one time. Now, the regulations also provide for a simplified dividend process. Now, these are all things that go on in the background and they're not going to be obvious to anyone, and I question whether they're going to have a huge impact. Not to mention that 60% of current liquidations in Australia have less than $10,000 in assets, roughly the cost of a standard creditor's voluntary liquidation. So to be honest, there's very few dividends being paid at the moment. So simplifying the dividend process probably isn't going to do much. Okay. Now, if at some point in time during the simplified liquidation process, the liquidator discovers company no longer meets the eligibility, they're required to convert it back over to an ordinary creditor's voluntary liquidation. So that's basically the new proposed regimes. They're basically giving companies or small businesses some extra options that than what's currently available. Informal arrangements, they're always around. Anyone can, any of you or your clients can do that, can start informal negotiation. Next is formal arrangements. So from 1 January 2021, it's proposed that voluntary administration is going to be available with the intention of doing a deed of company arrangement proposal or the new restructuring regime. And then from 1 January 2021, the simplified and regular liquidations will be available. I guess the big question is, if you or your clients are in financial distress, should they wait until 1 January before appointing an external administrator? And I guess that largely depends on the financial position of you or your clients and where they see the future. Whilst it's not currently in the legislation, there's, as I've said, there's an indication that employee entitlements are going to need to be brought up to date. So if you or your client's well behind in superannuation, then there seems little point waiting until the new regime comes into play. However, if your client is up to date with the tax lodgements, which they probably are, so they qualify for JobKeeper at the moment, and employee entitlements are in order, then there might be some benefit in waiting until the new legislation comes into play. Of course, if your client's not in a financial position to offer any money to creditors or unable to borrow money to pay creditors, then there's little point in considering the new proposed restructuring regime or a voluntary administration. But if your client is a small business and the only funds they have to pay for the liquidation come from personal assets, then it may be more commercial to wait until the new simplified liquidation comes into play, because it's meant to be presumably more cost effective. Look, at the end of the day, whatever you or your client decides, there's no harm coming to see us. We don't charge for our pre-appointment meetings, regardless. Well, I definitely don't, regardless of whether it turns into a job for me or not. I'd rather people get the right advice So happy to have a chat to anyone. So I just thought I'd see, were there any questions?
Excellent. No, I think you did such a good job, Michael. There are no questions, but if people do have questions, I think the best thing would be for people to reach out directly to you.
Yep.
So how is the best way to get in contact with you?
So my contact details are there on the screen.
Yeah, so there's a phone number 49238900, as well as your technical neutral way of contacting
That's
you,
right.
i.e. your email address.
Yep.
I definitely learned a lot of new things, including that term today. Thank you very much.
No dramas.
So I really do appreciate it, Michael, for painting a bit of a picture. This is a very difficult topic, and I think it's something that is extremely challenging for people to face up to and to live through. But the examples that you provided today, it's very clear to me that you can help people in business navigate a far better solution than they would ever be able to navigate on their own. And there's obviously a lot of legislation and other tricks of the trade, so to speak, that So yeah, I would highly recommend getting in contact with Michael from Worrells, the Central Queensland part of Worrells. So thank you so much, sir, for sharing your knowledge today with us. Really appreciate your time. And thank you for joining us for this week's HubLive. We only have a few HubLives left for this year, and then we'll kick off again in February. But do join us next week at 1 o'clock, next Thursday at 1 o'clock for our next HubLive. Thank you so much.
Thanks.